Hello, amazing people. Welcome to the Multifamillionnaire podcast. My name is Cheddy Matthews.
And my name is Selcuk and Cheddy.
Pleasure to meet you. It is so good for you to be here today. And today we're going to talk about some multifamily real estate myths. What are some of the things that we believe that may be true, may not be true? Well, let's demystify that right now. Let's talk about some of these multifamily myths that are out there right now. But first of all, before I even go into that, Selchuk, how are you today? How's everything going?
I'm great. Everything is going fine. Working on the deals every day. I
Love
feel
it.
good.
Good stuff. Good stuff. It's always good to hear from you. It's always good to pick your brain and get your knowledge. So I'm going to go
Thank you.
through. I have about 15 myths, and I get a funny feeling you're going to be able to demystify some of the myths I'm going to give you. You ready for this?
Yep. We'll see.
Here's
Let's
the
see.
first
Let's
one.
roll.
You've got to be extremely wealthy to invest in a large apartment complex.
Well, this is the biggest hurdle for most people, right? And they hear apartment complex and they think it's only for millionaires. That's not the reality is at all. And that's the whole point of a syndication. And it's a form of a group investing and a way to get into a deal you couldn't afford on your own. So instead of one person needing to come up with the millions, a group of people pulls their money together, and this allows everyday investors to own a small piece of multi-million-dollar asset. And while we're on the topic of group investing, I want to clarify something. The difference between the syndication and the joint venture, right? So they're often confused. So think of a syndication as a leader and the followers. The leader or the general partner does all the heavy lifting, finding the properties and arranging the financing and then managing the day-to-day operations. And the followers, the passive investors, they contribute their capital and get their share of the profit. So it's hands-off approach. And the joint venture, on the other hand, is more of a partnership. So it's typically a much smaller group of people who are actively involved in the deals. For example, one person might, bring the property and the business plan, while another brings the money. So they both have a more active role than a passive investor in a syndication. So the both ways are the great ways to tackle this myth, though, right? So they're not, this is not for just the millionaires. They involve different levels of participation. The key takeaway is that you don't need to be a millionaire to own a piece of $1 million building. Instead of come up with a 500,000 like a down payment, you might invest as little as like a 50,000. So that
That was good.
levels the
Thank you.
playing field.
That was great. Now I've got a second one for you. Yeah, that
Yeah.
sounds all great. You've been doing this for a while, Selchuk. You're kind of seasoned in this space. But isn't it difficult to get in as a first-time multifamily real estate buyer? Isn't it hard to get in, if you're on day number one?
Yeah, so people assume that process is long and complicated, so that you have to know all the terminology and all that. So it might seem that way, but it's pretty straightforward. And the real challenge is doing your homework. So for a first-time investor, I suggested like a checklist to guide your due diligence, right? So what should a first-time investor be looking at? Let's break it down. I break it down in like a three main areas, and the first one is the sponsor, right? So this is the most critical part. You're entrusting your money to them, and so you need to know their track record. And have they done deals like this before? Have they involved any business ventures in their career? How do those deals perform? Do they have a clear business plan? Then I also look at their team and their professional background. So vet the people behind the deal and not just the deal itself. And this brings the second the item. It's a deal. And so you need to understand the property's location, the market, and the projected returns. So one of the most important things to analyze is the market growth indicators. So you should be looking for market that is fundamentally strong and the growing. It's not just one-time spike though. So by the way, these days it's so easy to get all these info. It's like a touch of a button because I'm saying this when I explain all this, and the people can get good feels of how am I going to get that? It's just so easy. It's just so it's out there, like a public information. This is like almost like a public information,
Okay.
and and I this is important. I like to emphasize this market growth indicators in just a couple items again, and this is just like a again, it's out there, it's on everywhere and market growth what are the market growth indicators? There's like a couple of them. One of them is job growth. You know, a strong, diverse job growth, that's a leading indicator. And when companies are expanding or relocating to an area, so they bring new workers who need housing and all that, and that which boosts the economy for that area. You want to look for the mix of industries, though, not just the one major employer. And the second one is population. This goes hand in hand with the job growth, obviously. So people follow jobs and growing population like a singles, increasing demand for housing and rentals again. And the third thing you want to look at the rental markets trends, right? So what are the trends? What's the vacancy rates, and is it like a market with a low vacancy rates, and or it's just like rents are so low, and usually you can get those information from the professionals. They already blog thousands of different studies, and you can look at them just like a focus on that area and what's going on with that. That's it. So about the market and all that, right? So this was the second one. The first one was again, and the sponsor. Second one is the deal, and under that deal, need that. So the market growth indicators, and the third one is the legal documents, because eventually you're going to sign if it want to pull the trigger. Eventually you want to sign that legal document. So in syndication world, it's called private placement memorandum, or PPM. So it's the most important document. That's a legal framework for the investment. It outlines all the risks and fees and overall structure of the deal. So don't be intimidated by it. So this is where you find the full picture. So if you're a first-time investor, it's always a good idea to take that memorandum to show your CPA, especially the CPA and the attorney. And so the process isn't hard if you've done your homework, like a simple steps. The hard part is the finding the right deal and the right sponsor. That's that
Wonderful.
was my answer to that, Mick.
Oh, okay, nice. But now, with all that, it sounds somewhat complex. So, number three, my third question, or at least my third myth, wouldn't it? It would have to be, you have to have an LLC in order to invest in a multifamily deal, right? You got to have like an LLC or an S corp or some kind of a entity, a business entity established, correct?
No, we absolutely do not. The most passive investors invest under their own name. An LLC or other business structure can be useful later, but it's not a requirement to get started. So the main reason for that is that the sponsor, the general partner, has already set up a legal entity, and usually an LLC, and it's a hold the property and management investment. So as a passive investor, you're simply investing your capital into that existing legal structure. The sponsor for the LLC is, the one of the signs for the loan. They take on the liability and they handles all the day-to-day operations. And this means you get the benefits of the investment without the personal liability or the hassle of setting up and managing your own company. So the legal protection is already built in the deal. So that's why you don't have to have an LLC as a passive investor.
Awesome. So now this has to be true. You've got to have like perfect credit in order to do any kind of a multifamily real estate deal. That's got to be true. It's got to be.
No, it's not. It's not because when you invest in a syndication, you're not the one applying for the loan, right? So the loan is taken out by the general partner who organizes the deal. So they're the ones who need to qualify for the loan and they take on the liability for it. So as a passive investor, your your credit score doesn't come into play. And you just contribute to capital, making it this great option for people with less than a perfect credit. So
Oh, okay.
that's what it is
That's actually
basically.
good to know. I think a lot of people have to think about it. You don't need to have 100% good credit in order to work in these deals, in order to participate in these deals. That's good. That's a good opportunity for many people out there who think it's a barrier to entry when it's not.
Yeah.
Now, would you say that buying a large multifamily property through a syndication is the same as investing in the stock market?
Yeah, no, again, some people sometimes confuse syndications or joint venture deals with something like rate, right? They call it rate. I'm going to explain to that in a minute after I'm going to do this. So they're really different. And the stock market investment is like a liquid. So you can buy and sell shares with the click of a button. So a syndication is a private equity real estate investment. So your money is locked into the deal for the life of the investment, which is typically 5 years, a little bit more or less. So with a syndication, you can't just pull your money out of whenever you want. So this is a long-term strategy, so which allows the general partners to execute the business plan without worrying about investors pulling money out and all that. So and but the rate I just talked about a second ago, that's a real estate investment trust.
Yes.
It's a company that owns, in most cases, they operate an income producing real estate. Think of it like a mutual fund for real estate. They allow people to invest their real estate without having to buy or manage properties themselves. And the key difference is that the rate is a publicly traded company on a major exchange. So that's why you don't get the tax benefit out of it. We'll,
Mhm.
I like to talk about it if you have one of those in your list. So you can buy and sell shares. Well, it's just like you would do with the Apple or Google. But in the syndications, your money locked in. So
Nice.
to answer your question.
Nice. Number six, you just mentioned taxes. So I'm going to assume that syndications don't have any tax benefits. Is that correct?
Well, no, it's not correct. So this is just a plain wrong. As a matter of fact, the real estate, one of the most tax advantage investment there is. So through the appreciation, the general partners can deduct the cost of the property over time, even while it's gaining value. So these deductions get passed on to the passive investors. And this is a great distinction. I just talked about it, right? Second, between the rate and syndication. On the rate,
Yes.
publicly traded company, you don't get tax benefit. On a syndication or joint venture, you do have a tax benefits, and you get a K1 at the end of the year, which can show the depreciation losses that may offset all of your passive income. So basically, potentially living here with a zero taxes on that income.
Got
So
it.
you get your tax benefits there.
Number seven, I'm going to say so syndications don't require much due diligence. I mean, you have general partners and limited partners and all these other professionals. So you, as an investor, you don't need to do any due diligence. Is that correct?
No, that's a big mistake if you don't do that. The due diligence they do is a whole different ball game. They're the ones with the skin in the game, right? So the syndicators, they put their own money in the deal too, and they perform an ultra careful two-phase process before they ever make an offer on the property. I just want to go through this two-phase process real quick. And this first phase is the pre-contract due diligence, right? So this is the deep dive analysis before they even put an offer on the table. They research market. They're looking at the things like job growth and population, which is mentioned, and they make sure the location is fundamentally sound. So they also do a detailed analysis of the properties at the financials, checking like the rent roll and operating expenses to make sure the projections are realistic. They even create a financial model, the pro forma, and with the different scenarios to see how the deal performs if the market goes up and down or sideways. So that's how they decide if it's a good investment in the first place. So what happens after go under contract that brings the second phase, which is like a post contract due diligence. So you make your offer, they accept it, and now this phase start like this is like a finite window, like typically 30 to 6 days, where their team verifies every assumption. So they hire professionals, inspectors, the physical inspection of the property, so checking the roof and the plumbing and the foundation and etc. And this is a crucial step to uncover any deferred maintenance on expected repair items that could blow their top part with budget. So they also conduct a financial audit, so carefully verifying all the seller's numbers, and have a real estate attorney perform a title search to ensure there are no liens or legal issues. The lender will also order an appraisal to confirm the property's value. So it's a lot of work. So if they find a major issue during the process, something that makes the deal like unviable, then they can either renegotiate the price with the seller, or if the issues are too severe, and then terminate the contract and they get their earnest money back. And so this is why their diligence is so critical to the success of the investment itself.
Thank you. That was actually really good. So now here's another one. Okay, now Selchuk, I know you're like you're an LP and a GP. I mean, you're on both sides of the deal. However, you do so much of the work. You do so much of the due diligence. I mean, you are in there, sleeves rolled up, doing the work. So my question is, as a GP, as a general partner, aren't you taking the lion's share of the profits? Aren't you getting most of that money going into your pocket, not me as the limited partner who's just investing in the deal? Aren't you taking the biggest cut of that pie because you do most of the work?
Yeah.
How does that work?
Well, it's actually we as a general partner, and you know, we're getting smaller portion of profits. So bigger one goes to the passive investors. So it changes deal to deal, but usually it's like a 70-30 split. It's like a 70% investors, 30% general partners. And well, the general partners are paid for their work, right? To put in the hundreds of hours, taking on liability and managing the asset. And most deals are structured so that the passive investors get a preferred return first, and then the general partners get their share second. So the key takeaway is if you get offered smaller portion of the profit, just run away from that deal. So
Right.
basically, I mean the syndicators get the smaller portion of the profit.
That's good to know because it would seem, I think a lot of people think it's the other way around. Well, you're the GP, you're the general partner doing most of the work. Therefore, the investors get something, but after you get your cut, they get what's left over. So it's good to know
Yeah,
that's not the case most of the time.
yeah,
And that
yeah.
70-30 split roughly, I mean, it could be more or less, but 70-30 is actually favorable if you're a limited partner. You do less of the work, but you put the risk of putting your value in there with your investment and you get
Mhm.
the lion's share of that return back. It's pretty awesome to know.
Yeah,
Thank you for
yeah,
that one. Now,
yeah.
here's another one. So you've got a deal. I know you do deals all the time. So you've got this great deal. And once you do the deal, because I know you do your due diligence, so you're very good about kind of looking at the numbers and looking at what's between the lines, what's not written, what is written, and doing your background. You are like the master of due diligence. And with that, once there's a disclosure and like in of the investment returns, what you think your returns are going to be, and you kind of put that out to the investors, there are no hidden fees. What you see is what you get. Is that correct?
No, well, This is why it's so important to do your due diligence and read the offering documents.
Okay.
All fees should be clearly laid out and disclosed in these documents. If they're not, that's a major red flag. And all you have to do is just simple questions. Are investment returns before or after the fees? The right answer is after the fees. So they hopefully show everything on their presentation because you got to make sure. So as an investor, whether you're first time or second or third, and you don't want to be going on calculations or is it going to be before the fees and all that, how I'm going to get. So everything should be after the fees and after the fees and the profit share and everything. Whatever you see, it should be everything. It's clear and that this is yours at the end of the deal. So that's the thing you need to understand. If they're not really clear about it, just stay away. That's it.
Got it. That's good to know. Thank you for that. And now, syndications, they're only just about the cash flow, right? I mean, you have to wait until the property is sold and the deal is finalized and you've sold your investment and before you can realize any kind of profits. Is that correct? You have to wait until the very end. If it's a 5-year deal, 6-year deal, at the end of that is when you first see any returns on your investment. Is that correct?
No, it's actually the most syndications pay out distributions quarterly or sometimes monthly, and you get a portion of the cash flow from the property while the sponsor manages it. So, and
Awesome.
then when the property is sold, you get your initial investment back first, and the plus your share of the profits. So it's a two part profit center: the ongoing cash flow and the final payday. So you get
Nice.
your cash flow along the way.
That can be a win. So you almost get paid twice in two different ways. And that's good to
Mhm.
know. Just in case you have any doubts about that, you get paid two ways periodically throughout the deal. And at the termination of that deal, you get the distributions based on your
Mhm.
agreement and everything else. That's a win. That's a win. So whether you're trying to look for
Yeah,
income or for like an investment at the end of that deal, there's money in both. There's money in both of those spaces. So you can actually, it can be revenue generating or it can just be a savings vehicle, either or. So, or both.
yeah,
And I think
yeah.
that's so it really you can really tailor it to what you're looking for out of the deal, which is a win.
Mhm.
So now here's
Correct.
one. Number 11. General partners do not have to report to the passive investors until the deal is done. In other words, you don't have to talk to me as a limited partner. You don't have to tell me anything until the deal is very finalized. That's correct, right? No communication?
No, it's actually a good sponsor should host quarterly investor calls to provide updates on the
Nice.
property's performance and what
Okay.
they're working on, and they answer all the questions. So it's all about transparency and the communication, right? And so and also all investors will receive a K1 at the end of the year, and which reports their share of income and expenses and other tax items. So this
Yes.
is a yearly requirement for filing your taxes and taxes properly. So basically, the income level, you're gonna get your K1s and you got your reports and showing every year. But again, if you're good sponsor, if you have a good sponsor, the sponsor should communicate with their investor on an ongoing basis and either quarterly or monthly, either whether it's good or bad. You don't want to just to let your investor the good news. You just want to let them learn about everything. This is just like this. This is a business, everyday business. And sometimes it go a little down and all that, but in the long run, if you have a good strategy, then it should take you to the return you projected in the beginning. So
Awesome. That's
yeah.
good to know. So this sounds like a really good deal, but it would be better if you could invest in multiple syndications. It's true you can only invest in like one syndication at a time, right? You can only do it once, one at a time, and that's it. Is that correct?
No, you can invest in multiple syndication at once. And it's actually you should. So that's the diversification is key. And
Got it.
spending your money across the different deals and different sponsors in the different market is a great way to mitigate risk. And don't put all your eggs in one basket. So legally, you can invest multiple syndication at once.
That sounds
Yeah.
good. And it's interesting you talked about different markets. So for number 13, we're talking about different markets. Would you say syndications only work in big cities, big metropolitan areas, booming cities, and those large markets across the country or any country, really?
Well, the big cities get all the headlines, right? But are they the only places where great is? No. And in fact, some of the best returns are found in secondary and tertiary markets. So these are smaller cities that are still experiencing growth. And so, and at the same time, for syndicators, there's a less competition. And the general partners can often find better deals and better returns in the smaller markets. It's just all about monitoring your target area, target, in the state or city, what's going on regular basis, right? So what's kind of movement, going on in that, and then if you locate the good deal on the smaller market, that's better than the bigger markets because again, less competition, and you can find those in the smaller cities as well, towns as well.
Awesome. Thank you, Sasha. That's actually pretty awesome. So I'm going on to my second to last one, my penultimate one, number 14. All syndications, based on what you said, all syndications are the same because their advertised returns are similar, right? I mean, the numbers you're throwing out they seem kind of general. So I guess one syndication is
Yeah,
like another, right? If you've seen one, you've seen them all. Is that correct?
no, that's not the same. So it's easy to look at the list of deals and think they all look at the same, but you need to look closer. And the projected return is just a projection. So you need to look at the assumptions and the business plan behind those numbers. Some of them, like we mentioned a minute ago, like about the due diligence and all that stuff. That's the major the thing, and then you need to understand how the general partner plans to get those returns. And strategies can be very different. One deal might get project a 15% return by holding the property for 5 years, while another might do it like with a major renovation and they get value adds and selling in 3 years. Just ask, you know, what's their business plan and the exit strategy. And as long as you understand and it makes sense on the items on that plan and the exit strategy, you're good. But every deal is different. Every deal is different.
Got it. So here's you mentioned exit strategy. So here's another question. Number 15, my last myth, I'll call it that. After, sometimes you get a deal and it may be refinanced within a few months, a few years, or whatever it may be. After a deal is refinanced, will they buy you out as a limited partner? So I invest in the deal, you got as a general partner, all of a sudden you do like a refinance on that deal. Now you can buy me out. Is that right?
Well, no, this is a big one to understand. So when a property is refinanced, it doesn't mean you're getting bought out. So the purpose of a refinance is to pull some of the equity, out of the property to return investors. So you can get a return of some portion of your capital, but you're not cashed out completely. You will still own your percentage of the deal, and you will still get the cash flow and the final payday when the property is eventually sold. So that's your you know whole profit you're getting. But sometimes when the return is so great after refinance, you might get all your equity back at the refinance. So in this cases, some of the general partners may want to lower your split share. So be aware of that, right? And then you need to ask that upfront before you even put your money in. Okay, in case of refinancing, what what you gonna do? Am I gonna get like a lower split, or I'm gonna keep the split to start with? So you have to get that information upfront. But refinance doesn't get you bought out. That's the bottom line.
That is good. I think we have put 15 myths to bed and you've given us great clarity. So I wanted to thank you, Selchuk, for taking the time to not only dispel 15 myths that are probably floating in people's minds, but actually explaining the reality of the situation so people know what the myth was but what the ground truth is. So thank you for giving us ground truth. Thank you for giving us that North Star. And thank you for always stressing due diligence and doing the extra work and
Yeah.
just underwriting. You have a when I'm talking to you guys out there, when you have Selchuk, you are dealing with somebody who is so disciplined when it comes to the underwriting and looking beyond, asking the question beyond the question. Well, this, but if this happens, what about that? So you know the second, third, and fourth order effects. You know the primary effects, the secondary effects, the tertiary effects. He's thinking about these things so the deals are more solid, so that he can provide a better service for all of the investors. And it's a win. And when you ride with a multifamillionaire like Selchuk, you're going to be riding with someone who has your money, is a good steward, and is doing the due diligence and is underwriting for character and value and for clarity to make sure the deal is clean, solid, and is a great investment. So you can sleep well at night. And then when the term is over, you can reap your benefits. So,
Yep.
Selchuk, I
Yeah.
thank you so much for what you do. I thank you for sharing your time and your talents and your knowledge with everybody else. And if you have any questions, follow us, like us, subscribe, and share this podcast with anybody who's interested in learning more about multifamily real estate. Beyond that, if you like the show and you have questions, reach out to us, ask us your questions. Let us speak about and answer your questions online and live. And right now, it was short, it was sweet. We got in, we got out, we got the good information. And I want to say thank you so much for coming on today. Stay amazing. And we look forward to you being a part of the Multifamillionaire family. Thank you and stay amazing. And this is Cheddy Matthews. I'm signing out. And
Thank you. Thank you, everyone. This is Selcuk and Cheddy. Yep.
uh, thank you guys.
Thank you.